So you've been watching the news, and you've heard the Fed has raised its key interest rates again. The big question on everyone's lips, is the Fed done with its rate hike cycle? Or do we have more surprises lurking around the corner? On the one hand, we've got experts arguing that the Fed doesn't need to increase rates anymore because inflation seems well on track to hit the Fed's 2% target. Yet, on the other hand, Chair Jerome Powell has kept the door wide open for more rate hikes later this year if the situation calls for it. Quite the financial puzzle, isn't it? It's like trying to park in a tight spot. Move too far forward, you'll hit the car in front, but stop too soon and you're still sticking out into traffic. The Fed is trying to parallel park in the economy right now, and we're all waiting to see if they can pull it off without a scratch. Which side are you on? Is the Fed's rate hike journey coming to an end, or do we have a few more steep climbs ahead? Drop your thoughts in the comments below. We love hearing from you. If this is your first time tuning in, a big warm welcome to Investing Lighthouse. We're dedicated to demystifying the world of investing and bringing you tips, market news, and so much more. So sit back, grab a snack, and let's dive into this. So, what's the big deal about the Fed raising its key interest rates? Simply put, this move is like a thermometer for our economy. When things heat up too much, the Fed cools it down with a rate hike. And right now, we're looking at the 11th increase in 12 meetings, with interest rates now in the 5.25 to 5.50% range. To put that in perspective, the last time we saw rates this high was just before the 2007 housing market crash. So naturally, some folks are getting nervous. Yet Powell and his squad still leave the door open for future hikes. The Fed's official statement doesn't give us any specific promises. It's like when you ask your friend if they're coming to your party and they say, "I'll see, it depends on how I feel." Thanks for the clarity, pal. So what exactly is Powell saying? Well, he's focused on the totality of incoming data, mainly looking for signs that our economy is heading for a period of below-trend growth. But what does below-trend even mean? And why does inflation need to fall? Here's where things get interesting. You see, while inflation has reduced considerably from its peak, we are still dealing with core inflation at more than double what the Fed's target is, despite much higher interest rates than a year ago. Yet, the labor market seems pretty unaffected, with an impressively low unemployment rate of 3.6%. In addition, economic growth has stayed above the Fed's estimated 1.8% trend rate. In other words, the economy has been pretty robust, despite the Fed rapidly raising interest rates in its fight against inflation. But as always, there's a twist. To really win the battle against inflation, the Fed believes there needs to be some economic losses. You heard that right. In the wise words of Powell, reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. In simpler terms, to truly rein in inflation, we may need to take a couple of hits in the economy. Now, you're probably thinking, that sounds scary. Do we really need a recession or job losses? Well, Powell assures us it won't require a really significant downturn. But as he said, it's a long way to be sure, and there's a lot of work left to ensure inflation does not make a comeback. So, even though inflation data has been weaker than expected since the Fed's June meeting, policymakers have been reluctant to alter their approach until they see more progress in reducing price pressures. It's important to note that before the decision at the September meeting, the Fed will have 2 more CPI reports at its disposal. These reports will serve as a vital barometer, giving them a clearer picture of the inflation landscape and aiding them in determining the best course of action regarding interest rates. Therefore, if these additional data points warrant, the Fed may raise the funds rate again at the September meeting. And if inflation data is much cooler than anticipated, they may opt for a pause. It's an interesting game of wait and watch we are in, folks. Powell has warned us, though, not to expect any near-term easing in rates. In his own words, "We'll be comfortable cutting rates when we're comfortable cutting rates. And that won't be this year." Straight from the horse's mouth, folks. No rate cuts this year. Interestingly, this contrasts starkly with the market expectations of as recently as mid-June. Based on bond and futures pricing, the market was betting on the Fed to cut its policy rate by more than 50 basis points by year-end. Now that's a pendulum swing, folks. What does all this mean for us then? Are we set to ride a roller coaster of rate hikes? Or is the Fed likely done with the rate hikes for this cycle? The truth is, we can't say for sure. The Fed's forward guidance leaves the door open to future rate hikes if inflation does not continue to trend lower. However, there's a view shared by many experts that the Fed will hold the nominal funds rate steady into 2024. Even as we grapple with uncertainties, the Fed's data points towards a hopeful picture. With solid job growth and an economy growing at a moderate pace, Powell is optimistic about achieving what economists call a soft landing. This is a scenario where inflation falls, unemployment stays low, and we gracefully glide past the storm clouds of recession. However, Powell also hinted at a bias towards higher rates to dial back demand and prevent the economy from overheating. So, it seems that the Fed's parallel parking stunt isn't over yet. They're delicately maneuvering between inflation, job losses, and recession risks. Much like a driver trying to park in a tight spot, they're balancing the need for further rate increases against the risks of overcorrecting and causing a pileup. As we anxiously watch from the sidewalk, the question for the rest of us is, will they skillfully park without causing any damage? Or will we hear a metallic crunch in the near future? Stay tuned, folks, because this is one show you don't want to miss. We'll keep bringing you the latest news and expert analysis. So please give us a thumbs up and make sure you hit that subscribe button and notification bell to stay updated. And remember, investing can seem like a jungle sometimes, but we're here to make you help make sense of it. Keep learning, keep investing, and keep aiming for that financial freedom.